Hello, this is Seewing Yee from the Year Network. Thank you for attending this webinar recording. It'll be a little bit longer than usual. So I'm going to share with you the title of this webinar is Get Ready for the Real Estate Boom. So this is a big picture. I'm going to share with you our philosophies from a high level perspective, and hopefully you can get a lot out of this. And ultimately, I'm going to talk about long-term planning, long-term to create your wealth long-term. That's the bottom line. All right. So without further ado, let's proceed. Again, decide today how you want to define your life. So, what is your definition of financial freedom? Live your life by your own terms. The ability to quit your job and not worry about money. Live the lifestyle you want with no money worries, like traveling or take up a hobby. What is motivating you to make your money work hard for you instead of working hard for your money? Right now, look at yourself in the mirror. How much an average American makes in today's lifetime, in one's lifetime? The answer is $1.5 million. That's based on a conservative $50,000 per year salary multiplied by 30 years of working equals 1.5 million. Okay, and now don't ask me about, don't grill me about taxes and inflation, all those kind of things. I'm just giving you a high level philosophical, big picture education around wealth building. All right, so here let's continue. So therefore, you are already a millionaire. What's wrong with the picture? The picture is your paycheck is going to be taxed to the tune of 37 to 50%, right? That's including federal, state, and every other taxes, property taxes, and all kind of miscellaneous taxes. And 20% of your money go to home mortgage interest, which is not so bad, right? Those are good debt. 10% to other credit interest. Oh, by the way, this is bad debt. Only 20 to 33% of your paycheck left left for you at the end of the month. there's more there's more money at the end of there's more month at the end of the money as opposed to the other way around. Anyway, where does it all go, right? We all ask ourselves that. In our modern society, there are four categories of people. There are debtors, there are savers, there are investors, stock market, if you will. Then the part that I like the most, passive investors. All right. Which one do you think will make you the most money? I'm here to teach you how to become a passive real estate investor. Before I do that, let's agree that you and I will eliminate the word debtor and saver from our vocabulary. Now let's focus on becoming an investor. What's the Wall Street definition of investor? Buying stocks and bonds and mutual funds in your taxable portfolio and retirement assets such as your IRA and 401ks. By the way, I used to be a financial planner, okay, before I became a real estate investor. That was years ago. So I know what I'm talking about. I come from a good, vast experience in my financial lifetime. So I've been there, done that, all right? So keep that in mind. Not too many people have the vast amount of financial knowledge that I have. Not to boast about it. But anyway, let's continue. Do you realize that you've been buying your assets, quote unquote, sight unseen, all through your lifetime? Look at your investing portfolio. Stocks and bonds and mutual funds, IRAs, 401k, etc. Inside your portfolio of fractional ownership shares of various corporations and entities such as high-tech, blue-chip, brand-name companies, government entities, foreign companies, they are called mutual funds. Did you read and understand the prospectus prior to investing? Did you physically visit those several hundred companies located in different parts of the country and the world inside your mutual fund portfolio? Did you meet and talk to the mutual fund managers who you're trusting you to manage your money? Did you review the corporate balance sheets, the operating statements, and the financial health and history of those companies before you make your buying decision on those mutual funds? Well, the answer is probably not, right? Most Americans, they do not understand mutual funds because that's all they know. That's all they know. Buy something you understand, real estate, right? So, how are you doing with your stock market portfolio in the past 10 years? In the past year? Don't answer that, okay? Not so well, right? What is your rate of return right now? I arrest my case. Take a look at your IRA or 401k monthly statements. They show you a pie chart showing your mutual fund asset class allocation. For example, 25% large cap, 20% mid cap, 10% small cap, 15% cash money market, 20% bonds, 10% in overseas money. That makes up your mutual fund portfolio. All right, let's go over the magic of compound interest. The rule of 72. 72 divided by the rate of return is equal how many years for your money to double in value. So the assumption, let's use some assumptions. 72 divided by 5% equals 14 years for your money to double. Okay? Simple calculation. Example number one, you have $50,000 in your IRA invested in mutual funds today. At 5%, it will take 14 years to accumulate 100,000 inside your IRA. Instead, you could roll the 50,000 IRA into a self-directed IRA to buy real estate with the same 5% rate of return. So, what are the number crunching difference? Assuming the net monthly cash flow of $500 per month multiplied by 12 months equals $6,000 per year in cash flow. Multiplied by 14 years is $84,000 of net cash flow plus $100,000 of wealth accumulation based on the magic of compound interest. So 84K of cash flow plus 100 grand of appreciation in 14 years equals 184,000. Okay, versus 100,000 with the stock market. So I just gave you an apple to apple comparison how to use your IRA leverage to use your IRA to buy real estate at equal 5%. You will almost double the amount of money had you kept your 50K inside your mutual fund IRA portfolio growing at 5%. Okay? Once again, I rest my case. And the decision is obvious. Roll it over. Example two, you are already retired. If you're already retired, you can still invest in real estate using your IRA. There's no such thing as too old to invest in real estate. All right? Don't give me that. So you have let's say you have $400,000 in your mutual funds, stocks, whatever, in your retirement accounts, IRAs, previous employer 401k, whatever. Already retired, whatever that means, right? What is your age? Age 45, age 50, age 60, age 65? Doesn't matter. Scenario number one, you're taking out 5% of the portfolio on a monthly withdrawal from your 400K of IRA equals $1,666 of monthly net retirement income. Multiplied by 12 months, your annual retirement income is around 20,000. Can you live on that? I don't think so. Assuming a very low return, your money may run out in about 20 years. because 400,000 of your IRA portfolio in the mutual funds divided by $20,000 of annual withdrawal equals 20 years. Your money gonna run out. Americans' biggest fear is running out of money before they run out of time. Scenario number two, you convert your $400,000 into a self-directed IRA to buy investment property real estate. You will use $60,000 to buy a rental property with the cash, or with your IRA, you can leverage in a non-recourse loan because you can obtain 40% down with IRA and 60% loan to value with a non-recourse loan. The leverage against your IRA will allow you to purchase $140,000 of investment property. Okay, so each property will produce around $400 monthly net passive income. You can have the ability to buy 10 investment property at $140K each. 10 monthly properties rentals multiplied by $400 net cash flow per property equals $4,000 of annual rental net income from your 10 properties. Times 12 months equals $48,000 of annual retirement income from your real estate for life. By the way, your rent should increase around 3% per year. Okay, so if the average price of each home is $140K at 5% appreciation, the total value of your 10 investment properties today are $1.4 million, right? $140K per unit multiplied by 10. Using the rule 72, the value of your real estate portfolio in 14 years could be $2.8 million, double in value, right? How to design and build your real estate portfolio. Buy single family home rental, three beds, 2 bath, relatively newer homes with price ranges from 120 to 150K. By the way, these kind of homes are almost gone. Price is going up in good markets like Florida and Texas. So this is the sweet spot, right? You will cash flow tremendously, anywhere from $250 to $500 cash flow per month. Okay, with 20 to 25% cash on cash return. Or you can use your IRA to buy with cash and non-recourse loan, as I mentioned before. By using turnkey, remote, and sight unseen passive investing approach, everything's ready done for you, like our organization, the Yee Real Estate Network. There's no U.S. housing market, but rather thousands of micro markets, all with their own unique personality. Some have already recovered, some markets are close to being recovered, the others have a long way to go. The key is knowing which is which. Buy for geographic diversification. Do not put all your eggs in one basket. The numbers make sense now. High cash on cash return, high return on your investment, ROI, high rent to price ratio, and high cash flow. For example, here's the buying criteria. Buy at the lowest possible price at the highest possible rent. One formula you need to understand is price to rent ratio. It needs to be 1%. 1% multiplied by the purchase price of your unit, whatever the gross monthly, that will give you positive cash flow, regardless of down payment percentage, 20 to 25%. So if you buy investment property for $140,000, multiplied by 1%, $1,400 per month is your gross monthly income rent before deductions. That is the benchmark. That is the formula. Or maybe slightly less than 1%. Okay, 0.07 or 0.08 could be okay. Should be okay. All right. $100,000 multiplied by 1% equals $1,000 monthly gross rent, as I alluded to earlier. Okay, so again, the benchmark, the capitalization rate should be a double digit, at least 10%. Return on investment should be around 30%. But if you need to understand the numerical formulas more, contact me. I have many of those educational videos I will provide for you free of charge. Okay, and now is a perfect storm, small window of opportunity. Take action today and achieve your financial freedom. Where to buy? Population migration. Over the next several decades, people are moving away from Rust Belt states, manufacturing, industrial base, cold weather area, blue collar working class demographics, old houses, old neighborhoods in those areas, essentially the upper half of the US. Instead, buy warm weather, sun belt states, jobs, cutting edge technology, strong, diverse economic base, low cost of living, low taxes, recreation, retirement, new houses, new neighborhoods, emerging markets, attracting retirees, baby boomers, eco boomers. All right? Essentially, the bottom half of the US. According to the Bureau of Labor Statistics, the fastest growing states in the next 20 years or more are Texas, Florida, Arizona, Nevada, Georgia, and a few other states. Okay, so what's the best system to use? Here it is. Investment group, which is us, right? Evolution Network pays all cash at the courthouse steps, or investment groups have a direct relationship with the bank's REO department and purchases a block of homes on a deep discount. Investment group pays all the liens and encumbrances. Investment group uses its own cash to fix up the properties to rent-ready status, places a tenant before or right after closing, sell to specify exclusive groups of real estate investors only. Properties often are not in the multiple listing service, therefore not subject to bidding wars. Also, we provide turnkey approach to successful long-term investing with high-level property management and various supporting resources. Ideal for many of you busy people who works full-time. No need to become a real estate investor full-time, right? In summary, this is a remote control, turnkey, passive real estate investment. Similar in a way to mutual funds, but with real estate, the returns are much higher, as I explained today. You have essentially owned a single family home asset class portfolio, which will outperform Wall Street mutual funds asset allocation model. That's the bottom line. Okay, finally, for help with any questions or if you wish to do a telephonic consultation or video chat or a one-on-one face-to-face meeting, you know where to find me. Seewing Yee, the founder and CEO of the Yee Real Estate Network. My phone number and text is 510-552-0726. My email address is seewingyee@seewingyeeseminars.com, and my website is www.seewingyeeseminars.com. And thank you for attending so much, and look forward to working with each and every single one of you to achieve your goals. Thank you so much. Have a nice day. Good luck.